Welcome to SF Commercial Property Conversations with Bruce Bean, where Bay Area investments meet expert insights. Get ready to unlock the strategies of commercial real estate success.
So today we have Michael Sapuppo with us, and he originated from Andover, Massachusetts, and came out to California to be a windsurfer. But then he stayed in the mortgage business to kind of keep his windsurfing habit alive. So Michael, it's great to have you. It's going to be a fun conversation about affordable housing, I think. So give us a little history of how you got out to California.
Well, let's see. I started out in the banking business, specifically in commercial real estate lending. I was kind of, I knew what I wanted to do when I graduated from college. Didn't really want to get into the residential side. I graduated probably at the worst possible time in the real estate cycle, which was 1979. If you recall, interest rates were, well, prime was 18%. The unemployment rate, I think, was double digits. We had massive inflation.
The Jimmy Carter years.
The Jimmy Carter years. I actually met Jimmy Carter in college.
Oh, wow. Really? At Andover?
No, it was Trinity College in Hartford, Connecticut.
Oh, wow. Okay.
I remember he was on campus, and he was passing out little packets of peanuts.
Oh, when he was running for president?
Yes.
That is hilarious. Wow.
Right. But in any event, I graduated. I knew I wanted to be in the commercial real estate business, and I figured where would be the best place to start. And I figured that the best place to start was where the money was. So the money was in the banking industry. So I was lucky to have met a mentor, my first mentor, and he took me, under his wing, and he taught me, commercial real estate lending. It was great. I mean, I learned in, the span of 2 or 3 years what would have taken me, in a traditional, call it career trajectory, probably 10 years.
Oh, wow. Yeah.
And then I left the banking industry because I really wanted to learn more. And I started working I worked for a commercial credit company, which was, very high risk, high return type of lending, where you were really looking at the real estate and not the individual.
Oh, interesting.
Yeah,
wow.
The banking world, at least back then, was it was a country club business.
Oh,
True. If you knew the borrower, had personal relationships with him, he kept his money at the bank, and he had a lot to lose if he defaulted in terms of prestige in the community. You could bank him.
Yeah.
And hopefully he had a decent, real estate deal. That was the traditional banking back in the, certainly the 60s, the 70s, and even the 80s.
Right.
But I really wanted to understand how to underwrite, how to analyze, a pure real estate transaction without looking at, the financial worth of the borrower. And so I worked for a commercial credit company for a few years. And then I gravitated strictly to the multifamily sector, and linked up with the firm in Boston. It was the old Krupp companies. I don't know, probably no one knows about them, but it was Krupp. They were two Jewish brothers who did the classic Started out purchasing houses, fixing them up, flipping them, taking the proceeds, buying a 4-unit, and they built a huge empire. I mean, it was
Wow.
unbelievable how wealthy they became. And so they were one of the original syndicators
Wow.
back in the early 80s. It was like an incredible experience.
Oh yeah.
And they ultimately sold the company to, it was Deutsche Bank. They
Oh
sold
wow.
the company to, but I was hired. They acquired a small savings and loan in
Yeah.
Texas
Oh. Oh wow. Okay.
in 19, well, it would have been 1980, 82. Right. They
Yeah.
acquired a small savings and loan that they thought they could use as a piggy bank.
Oh, okay. Yeah. All right. Right.
And I was hired to be part of this lending group. And but then they realized that the regulators weren't going to allow them to make loans to themselves. So they took the entity and they created a multifamily mortgage operation.
Oh wow.
And they got their HUD medallions, they got their Fannie Mae medallion, and their Freddie Mac prior approval, status. And we did some of the first, multifamily originations.
Oh wow.
This was 85. Yeah, I worked for them from 85 to like 1990.
Oh, wow.
And what was really interesting about the Krupp organization was, I mean, this is really esoteric. I'm probably gonna.
Yeah, that's right.
They because of their money raising capacity,
Yeah.
which they would raise hundreds of millions of dollars in their syndication days, equity syndications.
Right. Okay.
So when they passed the Tax Reform Act, which kind of destroyed that business from a tax standpoint,
Right.
they retooled it and raised these massive participating mortgage funds.
Oh wow.
So
That was
they
early on.
and what we would do is the mortgage company would solicit developers and owners in the multifamily sector, and we would use the money that was raised in these syndications to fund the loans.
Okay. Yeah.
But they weren't straight loans. They were participating loans. So they had, part of it was debt,
Yeah.
but there was what we called contingent interest, which was a participation in the cash flow.
In the equity. Yeah.
Right.
Yeah.
And it was massively successful. So not only were they earning fees on the debt syndication side,
Right.
for raising and managing these funds, they also had a captive mortgage company that would originate the loans that they could feed into them.
Wow. Okay.
Yeah, George and Douglas Krupp. They were out of Boston. Amazing guys. Really, just incredible story.
Yeah, I'm gonna look that up. That is
Yeah,
for sure. So
so
were you
then,
actually in Texas or you were still back in the Boston?
No, the firm was in Boston.
Yeah, okay. All right.
But they had they did their syndication. Their syndication business was, for the most part, Texas.
Yeah, okay.
They were smart enough that after the, what was it, the 1975 recession, they
Okay.
went into Texas. That was the first oil bust.
Oh,
They went into Texas after the first oil bust and basically bought up every possible apartment building that they could buy. And
wow.
they had a massive portfolio of, equity syndications in
Right.
Texas.
Right. They paid cash, all cash for these
It
apartments.
was, yeah, it was
Yeah.
better than it was better than 1979. It was better than 2008. I mean, it was the first
Wow.
oil bust.
Okay. All right.
So anyway, they were based in Boston. They had the the equity syndications, and then they formed the mortgage company, debt syndications.
Right.
So how I got here to San Francisco, I originally tried to get them to allow me to come out here and open an office.
Yeah.
So
Okay.
that wasn't gonna. They didn't really want to do that. I tried. I tried my best, but I couldn't convince them.
Yeah.
So I figured out I still wanted to come out here. So I quit and moved out here, and I was lucky enough to link up with a firm that was in the city, same type of mortgage company, not as large. They were strictly, debt originations.
Yeah.
The name of the firm was TRI Financial Corporation.
Well, as in TRI. Well, wait. I worked for TRI Commercial Real Estate.
Yes. Okay. Well, TRI Financial was, let's see, TRI, the commercial company was, who was, his brother-in-law was the guy that owned the mortgage company.
Yeah. Okay.
Oh, what's his name? I used to see him all the time. The guy that started the commercial company.
Well, he was a pilot originally.
Yes.
Yeah.
Yes.
Yeah.
Damn it. I got
Yeah. No, I'm trying to think of the name also. We're gonna get it here in a minute.
Okay.
But anyway,
But
all right.
his brother-in-law,
The financial side.
the financial side, started the mortgage company. His name, by the way, was John Swayze.
Oh, okay. All right.
So I worked for John for 10 years. And their real specialty was the HUD business.
Yes. Okay.
And as a group, and they had a lot of ex-HUD employees on staff.
Right.
As a group, we really, really understood the HUD business, which is a very difficult business from the origination side.
Right. So okay. So that you go into the HUD business, but
Right.
then
We were originating loans for HUD mortgage insurance,
right.
which is a secondary market transaction. So you would work with HUD to get them to issue an insurance endorsement of the loan. You could then take that endorsement and create the liquidity by selling a Ginnie Mae mortgage-backed security, because the endorsement, the HUD guarantee, would
Right.
trade like AAA Treasury paper.
Perfect. Yeah.
So it had it had extremely low interest rate, very favorable terms, and yeah, very, very, very liquid, transaction in terms of raising the money.
So at one point, did TRI start getting into this affordable housing side?
They did from the lending side, from the
Oh,
debt
okay.
side.
Okay.
That was the real specialty of the company. As a group, we really understood how um, HUD worked, how the programs worked, particularly from the affordable side.
Right.
There are so many different rules, regulations. There's a whole historical context to all of the programs, and you had in one company all of the institutional knowledge, and we were really good at it. I have to say, we were really good at it at this
Wow.
stuff. So
Yeah.
we, there were a few of us in the firm. That we were working with a lot of local development groups who were doing affordable tax credit and tax exempt bond deals,
Right.
multifamily deals, and honestly they were tripping over themselves, and to us it was just second nature. And after we realized that we could do it with our eyes closed.
It was no sweat.
Yeah, it was no sweat. So the I want to say group, it was really just a very limited number of people, although some remained with the firm, with the mortgage company. But I and another person decided that we would form our own development company.
Oh, okay.
And in our first year, and there were three of us, we closed 5 deals in the first year.
Wow. Okay. And these weren't small deals, I assume.
No, they were all very large. The first, let's see, there was the first 5 were 410 units, 250 units,
Oh, wow.
72 units, 144 units. Yeah, they were all of that size. So
Yeah.
we were good at it. We were really good at it.
Huh. But these were not yet into the tax credit approach.
Yes, they were all tax credit deals.
Oh, they were all tax credit.
Yeah, they were part of the at-risk portfolio, the Section 236.
Oh, wow. Okay.
I don't know if you remember any of those.
No, I don't.
But
Yeah.
those were the projects that were built in the late 70s. No, excuse me. It would have been the late 60s, early 70s.
Yeah.
And they all had 20-year regulatory agreements. And the regulatory agreements were expiring in the early 90s.
Oh, wow.
And there was this huge legal battle between the owners and the federal government, which ultimately, was adjudicated favorably to the owners, but it took 10 years to get to that point.
Oh, wow.
Which is typical. That's how the federal government litigates stuff. They just tie you up in court until they can figure out another way, an amenable way to get out of a legal contract. And that's exactly what happened with these 236s. Though the owners were prohibited from converting them to market because the regulatory agreements ensured the affordability, but only for 20 years. So at the end of 20 years, the owners had the legal right to convert them, and some did.
Yeah. Okay.
But it caused, it was going to cause massive displacement.
Oh, right.
So
okay.
what HUD came up with was a program initially that allowed the owners to take out some of their equity.
Oh, okay. Right.
But the quid pro quo was that they would have to agree to extend the affordability restrictions for another 20 years.
Oh, wow. Okay.
Some owners opted to sell.
Yeah. Okay.
And that made a ready market for companies like ours to kind of act as the white knight. We would acquire, we would agree to maintain the affordability.
Okay. Yeah.
Okay. And we had access to the low income housing tax credit, equity, and tax exempt bonds.
Wow.
And that's what we did. So we raised the equity from the tax credits, via syndications, and we used tax exempt bonds for the debt. So we acquired the properties, did what rehab was necessary, agreed to keep them affordable. Well, initially, the state of California required it was a 30-year affordability. The first couple of deals we did were 30-year affordabilities, and then they changed it to 55. So the bulk of the portfolio has a regulatory agreement for 55 years.
But in some cases, I know this is true, that in some cases, the rents that are allowed under the tax credit scenario are very reasonable, are very good. No?
Yes and no.
Yes and no. Okay. All right.
Now, in our case, all of these properties had Section 8 rental assistance.
Yeah. Okay. Right. Yeah.
We acquired one that was a pure tax credit deal.
Mm.
But the rest of the portfolio were project-based Section 8, not
Okay.
tenant-based.
Oh, okay. Project-based. All right. So,
And project-based Section 8, it doesn't actually, there's a lag. It doesn't really keep pace with real market rent, but it's not that far off.
Yeah.
Okay.
So still pretty reasonable. Still pretty good.
Still pretty reasonable. And the legislation at the time, because HUD had to incent owners of these 236 properties,
Yeah.
to stay in the program, to not convert them to market, the legislation allowed for a markup to market of the Section 8 rents.
Oh, wow.
So when we acquired the properties, we were able to mark up the Section 8 rents to, what was considered market. It wasn't true market, but it was pretty close to it.
Sort of close.
Yeah. So, our cash flows were, sufficient certainly to service the level of debt that we took on and to provide, a reasonable return, to us as the owners. So it was it was a win-win for everybody.
Oh, yeah. No, at one point you got up to 2,000 units.
Right.
And now you're kind of backed off from that partners will be partners and, split up.
Well, the portfolio still exists.
Yeah. Okay.
I made the decision to sell my partnership interest in 9 of them.
Uh-huh. Yeah. Okay.
And my partner, paid me to leave the partnerships.
Yeah.
So I took my equity out of 9 of the properties, but retained my equity. I still have an equity interest in 6 of them.
So my brain kicked in and Bill Rossetti came up.
Yes, Bill Rossetti, of course.
Yeah.
Yes.
The pilot that became a real estate mogul.
Wonderful guy. Really terrific guy.
Really good.
He saw the potential of East Palo Alto before everybody did.
Right.
Everybody.
Yeah.
Really smart guy.
Yeah. No, he did very well during his term, so to speak.
Right.
Yeah. So, okay, so you got these tax credits, you bought these buildings, you still hold some of them, but now you're kind of quasi-retired, but you're still doing some work on the 6 that you still have.
Right.
Yeah. So it's all good. Well, this is very intriguing. I assume you're not out there looking to buy anything else.
Not not in the affordable business. It's way too complicated today.
Yeah.
There are a number of things. First of all, you can't buy these things at a price that makes any sense. You can't build them, for anything I don't understand how anybody makes money today
Yeah.
doing this business.
Yeah.
You can't build them. I mean, it's prohibitively expensive.
Yeah.
You can't buy
you can't build them.
You can't buy them because the numbers don't make sense.
Right. Right.
So, yeah, I'm always intrigued as to who's actually doing business. But I wouldn't.
Yeah. Well, this has been very intriguing. I think we should talk again. Who knows when? Maybe in 6 months or so, and just kind of see
Sure.
how the market is faring, because there's obviously a bunch of changes coming up here, and we're not quite sure which way the wind's going to blow.
Right.
So, well, this has been very interesting, very engaging, very, very intriguing, and I always like talking about affordable housing. So great to have you, and I look forward to talking to you again in the near future. So, if somebody wanted to come to you, Michael, where would they find you?
Probably the best would be email.
Yeah.
I don't generally answer the phone if I don't recognize the number. You know how that is.
Oh yeah, yeah. So many spam calls now.
Yeah, but email's great. I'm happy to talk to people about the affordable housing industry.
And this Michael Sapuppo is at Yahoo is the best one?
Yes.
Okay. All right. Well, very intriguing. Let's talk again.
That's a wrap on today's journey through the SF commercial real estate scene. Ready to share your story? Visit sfcommercialconversations.com/guest. Your insights could lead the next conversation.